Hello and welcome to the Private Capital Podcast. I'm Joe Riley, head of Circulus Group, a network for family offices based in Greenwich, Connecticut. Circulus will be hosting its next Family Office Summit on May 15th in New York for 75 family offices, and will feature Roger Ferguson, the former Vice Chair of the Federal Reserve, in conversation with Rebecca Patterson, a former and popular guest on this show. If you are part of a single family office, you can apply to attend at circulus.substack.com. Jason Mudrick is the founder and chief investment officer of Mudrick Capital Management, a firm renowned for its expertise in navigating complex credit situations and distressed opportunities. With a career spanning multiple market cycles, Jason brings a wealth of experience and a unique perspective on the evolving landscape of distressed investing. Foregoing a law career at Skadden, he did M&A at Merrill and then joined Contrarian Capital, where he learned debt at the right hand of Jon Bauer. Taking a leap after the financial crisis, Jason started Mudrick Capital with $5 million and faced the challenges of raising capital in a tough market that nonetheless contained many opportunities. Jason has lots of great stories, and we explore his current take on the debt landscape, his toughest year ever, creditor-on-creditor violence, and the wild ride of AMC. Please enjoy my conversation with Jason Mudrick.
This podcast is for educational and entertainment purposes only. Anything said by the guests or host should not be construed as legal or investment advice. Thanks for listening.
It's always best to start with just your background, what you did before you went to school, and your early interest in politics.
Grew up in Washington, D.C. Nobody in my family was in politics, but it's all around you. Went to school in DuPont Circle, and very much thought that I wanted to be in government, politics, something of that sort. Went to college and spent all 4 summers during my college years working for the House Banking Committee. Saw a Republican-led committee, a Democrat-led committee. I spent 2 summers working for the Financial Services Subcommittee, which is probably the most, I think, Wall Street-related committee of the set of committees that were underneath House Banking. And slowly learned that government just wasn't for me. The bureaucracy of it, the politics, the horse trading, it just wasn't what I was that interested in, but decided to go to law school. And a lot of people ask me why I went to law school. I actually went to law school because I had no idea what I wanted to do. And the law degree is such a flexible degree. It would allow me to do politics if I wanted to do politics, but also do law. And I came from a family of lawyers. My father was a bankruptcy lawyer, and also business. Whereas an MBA, you can't practice law. Could you do politics? Sure, but less likely career path. So it's such a flexible degree. I spent my first summer in law school working for the Department of Justice, so still government, but on the legal side in their criminal fraud division, and then gave up with politics. I said, I'm done with DC, and I spent my second summer in law school working for Skadden, which is one of the premier M&A law firms in New York. I studied economics at the University of Chicago for my undergrad degree, so I liked the business mindset, at least at the academic level. And in law school, I went to Harvard Law School. I was taking a lot of corporate law, M&A classes, bankruptcy classes, etc. But Skadden was the first time I was working on Wall Street deals on the legal side, but seeing the bankers, the principals, M&A deals, and it was 1999. So this was like the height of M&A, AOL Time Warner, like biggest M&A deals at the time happening. And Skadden was the epicenter of this. So it was an unbelievable experience. But that summer, I quickly realized that I wanted to be on the business side, but not as the lawyer. Oftentimes, and this is no knock on my legal friends, I think it's a great profession, but oftentimes like the business deal is decided or being negotiated, and then the lawyers are called in to paper it. And it's an absolutely essential part of these transactions, but I wanted to be doing the deals. I really think it's one of the best educations out there. But in terms of like practical case studies, that happens more on the business school side of the river. It was across the river. And I took business school classes. But so my favorite professor was a guy named John Coates. And I don't know if John is still there. I haven't talked to him in about a decade, but John was a partner at Wachtell, an M&A partner at Wachtell, and got out of private practice to get into academia. So unlike a lot of the professors at Harvard, he was like, this guy did the deals. Like he was a practicing lawyer that had all these stories of these big deals. And Wachtell was on the other side of Skadden. Wachtell defended companies from hostile takeover. Skadden usually was on the other side. It was Skadden and Wachtell were like the 2 top of the league chart law firms. John's classes on M&A were probably my favorite, even though he's probably not the most famous professor, but just because of his practical experience
And then you went to Merrill after that, right?
Yes, it's a good example of how fortune impacts people's career trajectories. I spent a summer at Skadden, and I joined Merrill Lynch's M&A investment banking group right out of law school. I thought I wanted to do M&A. Usually investment banks won't hire people right out of law school, but it was the late 90s, and it was this bull market, and it was a dot-com bubble, and many MBA students were passing up on jobs at Goldman or Morgan Stanley or Merrill Lynch to go to Silicon Valley for a get-rich-quickly entrepreneurial startup. For one time only, I doubt they've ever done it again. I doubt they ever did it before that. They were recruiting lawyers from law school campuses. It's not like I had been a banker for 5 years and then went back to law school. I didn't know how to use Excel. And here was Merrill Lynch and Goldman's M&A groups, the most modeling intensive, the divisions, the product advisory parts of these banks that probably require deep understanding of financial modeling. And they gave me a job because it was a bull market. Of course, I stepped foot into Merrill June of 2000. And the dot-com bubble burst, like all cycles. And M&A activity dried up. And of course, distressed activity picked up because bankruptcy activity picked up. I thought I wanted to do M&A, and something that I had no control over, just market forces pivoted me to distressed. I remember when the layoffs started happening in Merrill, I think we were in the third round. It's just a terrible place to be at a bank when they're going through these layoffs.
So give us a time. When was that?
This is now end of 2001, or maybe middle of 2000. I left in December of 2001, so maybe middle of 2001. And just a terribly uncomfortable environment because you know the layoffs are coming. They've been publicly announced, and you're just waiting to get tapped on the shoulder. And if you don't get tapped, your colleague sitting next to you or across from you is going to get tapped because it's just across the board. It's just a terrible environment to be in. And I remember my boss at the time, not the head of the group, but like the VP that I was working for, I was an associate, popped in the office. It was probably midnight. We're all still there. Back in these days, like you worked all the time. You didn't leave, especially during layoffs. That alone could be a reason they would fire you. You would sleep under your desk. We were there till 2 a.m. and back at 8 a.m. the next day. And this guy, David, walks in the office and he goes, "Hey, Mudrick, do you know what LIFO is?" And I had taken my accounting courses. I was like, yeah, last in, first out, right? This is a working capital accounting methodology. He goes, "No, lawyers in, first out." And slams the door and walks away. And I looked at my office mate and he looked at me and gave me a shrug. Sorry. He was an MBA student. But anyway, it was probably the most fortunate thing that happened to me, that recession, because there wasn't a lot of distressed specialized firms back then. It was really a niche product. There was about a half a dozen firms, all of whom had been spun out of, they were all prop desks at bigger financial institutions that had been spun out for conflict-related reasons. So Oaktree was formed in 95, spun out of TCW. Contrarian Avenue had been a broker-dealer called Amrock. They were formed in 95 as a distress specialist. Contrarian was Oppenheimer's prop desk, and it was spun out and renamed Contrarian, also in 95. A lot of these firms were formed in 95. They were all hiring, and hadn't been for a while because it had been a bull market. So I ended up meeting the team at Contrarian. It's a funny story with hindsight, but I lived in the city. I was 26 and single and having fun living in the city like we all do. And Contrarian was in Greenwich, Connecticut, like a lot of hedge funds were, because the founders and principals had all moved to Connecticut and for lifestyle reasons, tax reasons, etc. So I remember getting on the train from downtown New York, taking the subway up to Grand Central, getting on a Metro North train, going up to Greenwich, getting off the train in Greenwich, getting on a bus, and going down West Putnam. They were at 411 West Putnam, this silver building in the middle of nowhere across from a Wendy's, and getting off the bus on this highway. And by this time, I had already made up my mind, I'm never taking this job. And the only reason I walked in was because I didn't want to burn the bridge with the headhunter that had set it up. So I go in and I sit in the lobby, and Jon Bauer, who's a brilliant, distressed pioneer of the industry mind, but he's a little quirky. He's wearing his Reebok sneakers and khaki pants and button-up shirt, which he wore every single day to the office. Consistency. You got to give the guy credit for that. He's walking around with a speakerphone in his office, and there's all glass windows, and he sees me in the lobby, and he points to me and gestures for me to come into his office. And I'm like looking over my left shoulder and my right shoulder. Is he pointing to me? Because I don't know who this guy is. I knew that it was John. So I walk in, and there's this conference call going on, and he looks at me and he goes, "Hey, you're the lawyer, right?" He goes, "Sit down. I want your advice." I looked at John. I said, "John, what I was thinking was, I never practiced law for a day. What they teach you in Harvard Law School has zero practicality into like day-to-day world, especially like complex bankruptcy investing." And I specifically remember the conversation was about Federal Mogul, which was a distressed auto parts business, and it had asbestos liability. And they were trying to figure out how to quantify how big that liability could be. because the company couldn't come out of bankruptcy if more claims were going to surface. So there's something in the bankruptcy world called a channeling injunction, where you can set up in bankruptcy a trust that all experts will agree on what is the likely liability, and you fund the trust, and then you can emerge from bankruptcy and any future claim gets channeled into that trust. So you can have a clean, from a liability standpoint, a clean balance sheet. Otherwise, you can never emerge from bankruptcy because they're just the copycat claims. And this was on this conference call. I knew nothing about channeling injunctions, but what was fascinating to me is here is this guy. So I come from this environment at Merrill Lynch where there was managing directors, vice presidents, associates, analysts. And the analysts and associates, you did the work late at night and had it on the VP and director's desk the next day, but you didn't talk. They didn't want you to talk. God forbid you made it look bad. And you probably weren't working enough sleep to make a cohesive sentence anyway. To this founder of this hedge fund asking me my opinion about this situation I had no idea about. And it was just this awakening of how cool and flat this entrepreneurial, it was like 10 guys, they were managing $500 million, which was a lot of money back then. And I just, walking into this building, I said, I'm never going to take this job and I don't want to burn the bridge. When I walked out, I was like, how do I get this job? This is unbelievable. Because Jon actually cared what I thought, and I thought I could make an impact. I was never going to make an impact at Merrill Lynch. So they gave me Federal Mogul as the case study. I went home, I canceled my, I think it was Thanksgiving break, and spent the next 5 days putting this case study together, and went back between Thanksgiving and Christmas and pitched it, and they made me an offer. And the rest is history.
Were you in World Financial with Merrill?
30th floor for World Financial. That was the M&A floor.
And then you guys all had to move out, right?
When 9/11 happened, I actually wasn't in the building when it happened, but my apartment building was on the corner of Worth and Broadway and looked down Broadway right at the World Trade Center. And it was the Tuesday after the holiday, so Labor Day. And I had a late flight that got in late that night. We had traveled. So I was a little late going to work, but I had all these disposable cameras. Back then, this was before digital cameras. Mm-hmm. So I had all these that you'd buy at the drugstore, you'd wind them up manually and take photos because we'd been on vacation, and I had a bunch that were unused. And when the plane hit, I was getting ready for work. I just sat there and front row seat, and 10 blocks north, but high up in a building with a direct view of the World Trade Center. And I used those cameras, and I still have those photos, though. And I never shared them with anyone. They were sitting in my living room in a shoebox. But when the towers fell, we all evacuated. And we worked out of Weil Gotshall's offices in the GM building. They gave Merrill a floor. And we worked there for a few months until downtown opened back up. But of course, we didn't go back to Forward World Financial. I actually never stepped foot back into a Forward World Financial Center. There was a building on Broadway right across the street from Ground Zero, like closer to that Forward World that hadn't been damaged, that they had found some space in. And the toxicity in the air, you could smell it and you could taste it and you could feel it on your throat. Within an hour, your throat was scratchy. Mm-hmm. And I was going to my direct report and saying, hey, like this can't be healthy. Like my throat is scratchy. And he's like, it's fine. Don't make waves. Like we're in layoffs. I was like, all right, that's fine. Keeping my job and losing my job versus dying from throat cancer. I need to know if the air is healthy or not. So they actually brought in all these machines to monitor the quality of the air, and higher ups all walked around and said, it's fine. It's not fine. Like my body is telling me it's not fine. But that was when I took the job at Contrarian, they were still in that space. I never stepped back. The last time I was in World Financial Center was the Thursday before 9/11.
So you launched the Contrarian Equity Fund in October of 2002. Did you have much experience with distressed debt at that point?
I joined Contrarian in December of 2001, December 3rd, a very specific date that I remember because it was the day Enron filed for bankruptcy, which at the time was the largest bankruptcy in the world, only to be surpassed 7 years later by Lehman. Walk out of my apartment building, pick up the Wall Street Journal front page, largest bankruptcy in the world, and I'm going to my first day at a distressed debt firm. Again, how much luck and fortune plays into these things. So I worked on Enron, a lot of other bankruptcies, and what I saw was when this debt gets converted to equity, a lot of the firm's knee-jerk reaction is just to sell it. And some of them you should sell, but some of them are really cheap and you should buy more of, or at least hold. So I approached the partners at Contrarian less than a year in, and I said to Jon Bauer, we should have a fund that can specialize in these post-reorg equities. There's a whole theory about why they trade well. They get really cheap. There's not a logical buyer. The business is usually turned around. the stigma from the bankruptcy gets removed over time. There's a new incentive plan for management. Oftentimes there's a new management team. A lot of times the economy drove the company into bankruptcy and then recovers. So there was a lot of empirical evidence, at least back then, that post-reorgs outperformed the market over time. And if you could pick and choose the best ones, and we were logically situated as a distressed focused firm, like we knew all these companies, all the companies that were coming out of bankruptcy, even though there was no longer an opportunity and they're dead, which is how these investments started. We had looked at all these companies and oftentimes had invested in them. So they loved the idea. Jon said, I've always wanted to do this. I actually already have an entity set up. I set up when we launched the firm called the Contrarian Equity Fund. I just haven't set it in motion yet. Let's start it. I'll seed it. You run it, but do it on the weekends and in the evenings. You're still my analyst on the distressed debt stuff. I said, okay, that's fine. And it's another funny story, but back then, hedge funds were fairly, I don't want to say unsophisticated, but it was just all about making money. There was not a lot of institutionalization, and the marketing materials that Contrarian had were like literally it was like a 7-page Word document. Like it wasn't even a PowerPoint slide. And that was the way business was done back then. And I had come out of Merrill Lynch as an associate, and a lot of what you do, especially when you're in an M&A group in a recession, is pitching. So I had some skills with PowerPoint back then. So I said to Jon, that's fine, but can I redo our marketing materials? I can bring the team in from Merrill, we'll pay them on the side, the sort of graphic arts team, and deliver materials, and I'll stay home for Christmas, I'll get all your input, and he's like, great, that's amazing, great idea. And I said, there's one caveat, I want to put a section in there for the Contrarian Equity Fund. And maybe we can raise some outside money, because it was just internal money when I launched it, my weekend project. And we launched it in October of 2002, and it came out of the gates really strong. Part of that was market bottomed, and October of 2002, retested the lows in March of 2003, and then we're off to the races. So the timing was great. So we had launched it in October, and that Christmas I stayed home and brought this team up from Merrill, these sort of graphic artist specialists, paid them for the hour on the side. And when Jon and his partners came back from Christmas, there was a beautiful professional investment banking type marketing deck that had their funds and the Contrarian Equity Fund, which was their fund, but the fund that I had launched and was managing. And the fund started doing really well into 2003, and a lot of clients started asking about it. And Jon would say, oh, no, I know there's a section in the deck, but that's just our own money. We don't have any outside money in that. And that made people want it even more. And we started to get interest, and we started to raise money. I think within a year, we had crossed 100 million. The fund got up to about 400 at its peak. But at some point, I turned to Jon and said, hey, this should be a full-time gig now. I should go hire an analyst, and this is scalable. It's generating real revenue. It's covering my cost. And Jon agreed. So I was still an analyst. There was a lot of overlap. A lot of this debt would convert into equity. So if there was going to be a debt for equity conversion, I would be the analyst, even if it was going into multiple funds. But it was really a full-time focus on the Contrarian Equity Fund at that point. And the fund did great. It had a 6-year audited track record. I said just because I used that track record when I left in 2008. And it annualized at 19.5% net, which was Contrarian's highest returning product during that period. Now, it was the funds focused on creating equity, so it should have been the highest returning fund, but it was that track record and obviously the experience. And look, the mentorship of Jon, I sat next to Bauer for 7 years, literally like it closer than we're sitting, and I could smell what he had for lunch every single day. We were on a trading desk. So to be able to learn from that team, and Jon specifically, I started the day Enron filed, I left the day Lehman filed to be bookended by the 2 largest bankruptcies in the world. I saw the hedge fund industry institutionalize. I think the entire industry was about $200 billion when I started. It got up to $2 trillion by the time of the GFC. So I saw 10x growth in the industry, and the institutionalization that naturally happened along the way. Later, really catalyzed by Madoff, but even ahead of Madoff, independent administrators, audits, all this stuff just became par for the course. And I got to see the firm grow. Contrarian grew to $5.5 billion by 2007 from $500 million when I started. And what worked, what didn't work, from compensation, hiring, and I got to see it from the passenger seat, not from the driver's seat, which was invaluable. That was really my grad school. My law school was great, and it opened a lot of doors, and I have a fancy piece of paper on the wall, but really where I learned the business was just getting thrown in the deep end, which that was the hedge fund business back then. Literally, the day I showed up at Contrarian, you asked me if I knew anything. I knew nothing about distressed debt. Jon said, you're on Enron. Literally the biggest, probably until Lehman, most complex bankruptcy ever. That was the first credit I've ever worked on, not even knowing the difference between a loan and a bond. I didn't you learn on the job.
Talk about moving from the passenger seat to the driver's seat. What was your thought process around that, and why did you start Mudrick?
I always wanted to run my own fund, but look, I knew that I had no experience and wouldn't be able to raise capital until I had that experience. By '05, I was starting to think about leaving, but we had a little bit of golden handcuffs, and like it was a bull market, and we were making money every year, and assets were growing every year, and it was really, that was the heyday of hedge funds. Rising tide lifts all ships, and we were top quartile almost every year. So we were capturing, and the whole business was growing tenfold over that 7 years, but we were capturing an outsized share of it because of performance. So it was just hard to leave. But then when the GFC happened, oh, and also there wasn't a lot of good distressed. Like at the end of most bull markets, like it was getting challenging to find good deep value opportunities. So that all changed in '08. Right? The opportunity set got, you didn't know when it was going to bottom, but all of a sudden every senior loan of every LBO was traded at 50 cents on the dollar. And so the opportunity set got very robust. And fund performance, that was the crisis for hedge funds. If you offer liquidity, which most funds did back then, drawdown funds, longer lockup closed-end funds, which is the norm for distress today, those were the exception to the norm back then. Everybody offered quarterly liquidity, 90-day notes. So assets shrunk fairly materially across the industry. Performance was bad, but the opportunity set was great. And I had a track record. To Jon's credit, the Contrarian Equity Fund was a separately managed vehicle. So I built a 6-year audited track record. And so I sat down with the partners at the end of '08. It was long coming for me, but like the catalyst was the GFC because everything changed then. And they were supportive, to his credit, because it was a challenging time for all of us. It was crisis. Everybody was down a lot. Investors were redeeming, people were gating, people were side pocketing. Not fun environment to go through if you're a hedge fund manager. But Jon gave me a handshake and a pat on the back and said, we'll give you money and we're supportive and good luck, which he didn't have to do. And he let me take my assistant PM with me, a guy named Vic Don, who's launching his own fund now. And he was with me, he came with me here and spent the last 15 years with us here. So Jon let all that happen. So we left at the end of '08 and set up shop in early '09, and that was 15 and a half years ago.
And what was the first year like?
The first 6 months were all just infrastructure. It was hiring, finding real estate. We hired some analysts, we hired an IR person that came with me, we hired a CFO. So a lot of internal focus. We were diligencing opportunities because there was so much going on, right? And you remember, like the market was still very volatile that first half of '09. Every day the Dow was up 1,000 or down 1,000, and it was that kind of environment. So we were researching and putting together a mock portfolio that we would launch with, but a lot of it was internal marketing, trying to find seed investors. Fortunately and unfortunately, it was an incredible investing environment. Some of the opportunities that we were finding, it was like, what's the right analogy? It was shooting fish in a barrel. I mean, it was like really good businesses with just impaired balance sheets where you were creating them for 2 times cash flow, 3 times cash flow, and brainer type stuff. The unfortunate part was it was impossible to raise money. Everybody was, and that's why liquidity came out of the market and why things were so cheap, is nobody had any capital.
What did you start with?
We started with just my money. We launched for $5 million. And then that was July of '09. Month 2, we took outside capital. We took 17 million in. So we had 22 officially, if you include my money and the first round of outside money. So that was enough. It was challenging. You're not a QIB, qualified institutional buyer, when you have less than 100 million under management. If you're not a QIB, you can't buy 144A bonds. You can't buy loans for the most part. Banks won't take the counterparty risk with you. We were fortunate in that there was a lot of liquid bonds that you could buy as a non-QIB that were very distressed, and we started to build the business originally around that kind of stuff. And through relationships, we convinced some of the banks to let us trade loans, even though we weren't a QIB. They were a little bit less strict about it back then. But performance was good. We came out of the gate strong. Timing is so important. You can be the smartest hedge fund manager in the world, and if you come out of the gates and you lose money your first year, and every smart hedge fund manager has lost money in a year, you're done. Maybe if you have enough brand equity in your name from prior experiences, maybe they'll give you 2 years, but if you don't make money in the first 2 years, your clients are sticking with you. So timing is so important. And launching in July of '09, arguably we should have made a lot more money. We made 20% in the first 6 months, not annualized gross, so whatever that is, 50 or 60% annualized. That helped. And then it was off to the races. And the trades that we were putting in were very differentiated. We were using our smaller size as an advantage, and there's very few small distressed funds back then, because if you were small, you went away in the GFC and nobody was launching. So it was all the oak trees of the world that were out raising money, and we could really put together a portfolio that was totally different risk. Like there was a company called CIT, which was a big lending business. Just to give you an example, they had raised money from Wall Street through the bond market, and were lending it out to their various markets. And they had also borrowed money from retail investors. They came up with technology where there would be a common indenture, and every month you could go out and raise money and it would tie back to the same indenture. There'd be like an entire bond issue with its own CUSIP that was $150,000, because that's what whoever they were using to distribute these bonds, that's what they raised that month. And the next month there'd be a different CUSIP, all the same credit, same indenture, but different CUSIP, where they raised $350,000. And then the next month they'd raise $3 million. Then they raised $1 million. And these things were called retail notes. CITs, they all had their own brand. CITs specifically were called internotes. And those internotes were trading about half the price of the bonds, but they were small. So you couldn't put a lot of money to work, because you're buying $1 million, the entire bond issue might be $1 million, and at 50 cents on the dollar or 25 cents on the dollar, that'd be $250,000. So none of the big institutions cared, but we were scooping up CIT risk. We had to put together a portfolio of hundreds of trades, even at our size. But we were so small, we were able to put a 5% or 6 or 7% position, whatever it was, in the bond at half of where they were trading. The pari passu liquid bonds were trading. So think about that. You could actually go out and short CIT bonds against the internotes and have a risk-free 100% return, gross return. The only thing that would be up in the air was how long it would take for them to collapse. And the bankruptcy, which was going to happen and did happen, everybody would get the same new securities. So that bankruptcy would be the catalyst for the collapse, which happened within a year. So it was like, think about it, a risk-free double in a year, in less than a year. That's the kind of stuff you could do back in 2009 if you were smaller. Another funny story, we hired this analyst. He's still with us today. He's one of our most senior investors. His name is Shankar Murugavel. Shankar had just started with us. I think he started like in April, and this is now like July. So it's like he's been there for 3 months, 24 years old. CIT was based in New York. And this one trade we had put on, we had found a security, it was a pref. It's a long time ago, so I may get this wrong, but it was convertible into a certain amount of shares, but if the company got delisted, the conversion ratio went up by 5x. It was a provision put into this pref instrument to basically compensate people if the business got delisted by saying you're convertible into 5 times more shares. So the pref was trading at 20 cents and the stock was at $1, but the pref was really worth $1 if the company got delisted. But you had to understand the mechanism to convert, because they had just made naked short selling illegal. So like you couldn't just buy it and short it, but the lawyers were telling us, but if you've given notice to convert, it's not a naked short, it's an actual short, even if you haven't received shares yet. We couldn't get CIT on the phone to figure out what we needed to do to provide this notice. So I grabbed Shankar and said, go to CIT's office and don't come back until you get instructions on how we convert. Because this is a risk-free 5 times return, not double, a risk-free 5x that a big fund couldn't capitalize on because it was like this 20-cent preferred, but like we could take a meaningful position in, given our size. And Shankar looked at me and he said, what happens if they won't? And I said, just don't come back until you figure out how we convert this. And he looked at me and looked at Vic, my partner, and left. And about 2 hours later, the phone rang, and it was the security desk at CIT. And they said, does Shankar Murugavel work for you? We said, yes. He said, he's here in the lobby, and he says he won't leave until he talks to somebody from IR. And I said, can you just put him on the phone with somebody from IR? And about a half hour later, the IR called us. And they said, all you need to do is send us an email of how much you have and how much you want to convert. And that allows us to put the trade on. So it was just, we were small, but it was a great investment, Byron.
I was reading about you folks and your great comeback story from 2015 to 2016. And we were talking earlier about it, is how nuanced and how often the public perception of what happens is totally different from what happens on the investor side. So maybe you could tell us a little bit about that.
So you mentioned 2015. 2015 was our worst year ever, including my time at Contrarian. And it wasn't a terrible year for the markets. What happened to us in 2015, which again, if you're from the outside looking in, you may not have fully appreciated, was we were in a bull market. We had thought there would have been a more robust distressed opportunity by 2014. That was our pitch when we launched the firm in 2009. There was this wall of maturities. It was peaking in 2014. And we believed that the refinancing events would be this catalyst. But what ended up happening, because of zero interest rates and all the fiscal and monetary stimulus that was happening, everything got extended. So we're in this environment where there was nothing to do in stress, despite our thesis that there would be. And all of a sudden, oil prices collapsed. Energy producing businesses, oil and gas businesses, were the largest component of the high yield market at the time. They were about 17% of the high yield market. And their end product went from $120 to, at the low, $28. That created a tremendous amount of distressed opportunities, but in one industry. The biggest mistake that we made, and the lesson we learned from that, was from a diversification standpoint, no matter how good of an analyst you think you are, in extreme environments, correlation goes to 1. So we had invested in 7, or maybe it was 8, unique special situations in the energy space, but all companies that we believed had different catalysts, different situations. Some were in oil field services, some were in exploration, some were onshore, some were offshore, some were based on replacement value of rigs, where we were investing in the project level debt. They were all unique bets to us. And ultimately, we were right. They were unique. If you fast forward 5 years and you look at how those investments performed, some performed great, some performed terribly, some were okay, but there was a real dispersion in outcome, but not in 2015. By the time we put those positions on through the middle of 16, they were correlated to each other by about 1, and they were correlated to oil, probably more than 1, but high correlation. So oil went up, they went up, oil went down, they went down, and we weren't making it better than oil. We never claimed to have any kind of edge in what oil prices are going to do. We thought we had edge in understanding the value of these businesses long-term over the course of a cycle, and that we're creating them at sometimes a third or a half of what we thought they were worth. But it put a tremendous amount of volatility in the book. So we were down a ton in 2015, all unrealized. Fortunately for us and for our clients, we made it back very quickly in 2016. I think in 4 months it took us to make it all back. But that was the lesson. That was a lesson from that period of time. Since then, we cap industry exposure at around, we say 20%, but really at around 10%. Energy is a tough asset class, a more nuanced lesson. There's a lot of promoters on the management teams. If they're in that industry, they tend to be perma-bulls, so they're always bullish. Part of our diligence process is to get to know these management teams, and I think that was a blind spot for us. They were just also bullish. They're also very capital-intensive industries. And it's often very hard, particularly on the E&P side, the exploration side, it's very hard to diligence what's in the ground. Like, you're relying on expert reports. You can't go kicking and feel it. The longer term lesson, the shorter term lesson was industries can get very correlated, positions can get very correlated in periods of heightened volatility. You have to think about that when you construct your portfolio from a diversification standpoint. But the more nuanced lesson was just energy is just a tough asset class. So we don't look at oil's $80 now or $70, wherever it is. So there's not a ton of distress in the industry, but if it does collapse, it's unlikely that we would make material investments in that space again.
I imagine that's got to be just an occupational hazard that most of the companies in a particular sector will all go south at the same time. So it's the opportunities are ripe for picking, but you don't want to become overly concentrated.
One of the things that I'm the most excited about today, if you think about the lessons we learned in 15, and by the way, in other periods of time over the last 15 years, we've been in a bull market with basically free capital until a few years ago. There was industries that were in trouble, energy being an obvious and acute one in 15, but retail with the Amazon effect, there was a lot of distress in retail, some legacy media that was moving from analog to digital and going through sort of transformation, whether it was newspapers or radio, or other kinds of broadcast. But a lot of the stress and distress was concentrated in a handful of industries. You're right, as a portfolio manager, we're taught Portfolio Management 101, diversify. And you diversify across issuer and you diversify across industry. And people can have different appetites for risk in terms of what that means. You can be very concentrated and have 10 positions. You can be very diversified and have 100 or more positions. We tend to be a 20 investment type firm, 5% type positions, but that's unique to the portfolio manager. But diversification is important. So when you're supposed to be a distressed manager and there's only a few industries that are distressed, you have to take risks somehow. And more the risk that we were taking back then was in industries. Today, the catalyst for the opportunity set has not been an economic downturn. It's been the normalization of interest rates. And the normalization of interest rates at a time where we're coming out of a 14-year good market, okay? No recession besides COVID, which was driven, that wasn't a business cycle, that was a pandemic. No recession and zero interest rates. That encouraged a ton of borrowing. Okay? So we had a normalization of interest rates at a time where you have the largest amount of non-investment grade credit ever, okay? Basically a threefold increase from the GFC. And it's very wide horizontally because very few industries resisted the temptation to borrow when rates were zero. Even tech companies in Silicon Valley, pre-revenue, pre-EBITDA, were borrowing because the money was there and it was cheap and it was free. So as a distressed investor, that was the backdrop. And with rates moving up, it impacts all borrowers. So we don't have to worry about having too much energy exposure or too much retail exposure. we can diversify not only across issuer, but across industries, because every industry, almost without exception, has over-leveraged borrowers that are now feeling the sting of higher rates. And that's a environment we haven't seen, right? Everything was distressed in '08, everything was distressed in '01 and '02 because you're coming out of a recession. But who knows when the next recession will happen, right? The opportunity set today, interest rate cycles are not 9-month cycles, right there. These are multi-decade cycles. And the environment that we've set up today, I would argue, is the result of 40 years of declining rates and became enormous because of 14 years of zero rates. So from a diversification standpoint, that's not a risk anymore. We can diversify this portfolio easily. I'll never forget the lesson we learned in 15, and we've adjusted our risk mandates as a result of that lesson, but that is not the risk I worry about today.
So what do you worry about today?
From a macro standpoint, I think the biggest risk is that there's just too much debt. Now, we haven't seen it impact GDP yet. The economy still seems fairly robust, but everybody's got auto loans, leases. Everybody's got mortgages, student loans, credit card debt. And most of this debt was put in place in a different environment, a different regime, a different rate regime. I think we borrowed forward a lot of growth by keeping rates at zero to reflate the economy post-GFC, and there will be a hangover and consequences to that. So from a macro standpoint, I'm worried about slowing growth. And from a market standpoint, when rates went to zero, not initially, but once people realized they were going to stay at zero, the equity markets were off to the races. And some of that was because of decent growth, but a lot of it was because of multiple expansion. People got pushed out the risk curve. And if you think about it, what is the value of a business? The value of a business is all of its future cash flows discounted back to today. When 2008 was farther and farther in the rearview mirror, analysts tend to take their recent experience and project forward. That's human nature. So they were projecting earnings growth to infinity, and they were discounting it back at zero. The 10-year was at 40 basis points. So that resulted in unprecedented multiple expansion. So the equity markets, there's a lot of noise in the markets with tech, but more or less went up by about 50% in terms of the way businesses are valued as a multiple of their earnings. So the S&P went from, call it 8 times to 12 times. It's at 16 times today, but there's all the NVIDIA stuff in there. Let's call it something like 8 to 12 or 8 to 13. Private market valuations went up the same way. From a market standpoint, I think, and by the way, rates went right back up to where they were in 2007. A lot of people that invest today have never invested in a world where rates weren't zero. Last time rates were around 4.5% was the year the iPhone was invented. iPhone 1.0 was 2007. That's the last time rates were here. So you had zero rates, all this debt borrowing, all this new crop of analysts that have only invested in this kind of environment. And I would argue, huge multiple expansion as a result of zero rates. And then rates go right back up to where they were in '07 very quickly. But guess what hasn't happened yet? We haven't had any multiple contraction. No mean reversion in multiples. And that feels to me like that's unsustainable. In fact, we've had the opposite. We've had multiples continue to expand despite the fact that risk-free is 5%, 4.5%. That doesn't make sense academically. So we can talk about productivity increases with AI and whatnot, but I think that this is more a human psychology thing and a buy the dip and a fear of missing out. And when it moves the other way, and predicting what will catalyze that and when is impossible. But something will catalyze a downturn in the equity markets, and you'll have that crop of characters that go in and buy because you buy the dip. But when that stops working and greed turns into fear, I think the multiple contraction, even if you don't go back to anything close to 8, but just go back to the sort of historical average, could result in a lost decade for equities. So macro, I'm worried about slowing economy. Markets, I'm worried about multiple contraction, which I think should happen in this interest rate environment. And then you specifically asked about nuances of debt investing. Fortunately or unfortunately, one of the phenomena we've seen during this bull market is covenant-light loans. I'll hear people talk about cov-light. Loans always had covenants in them before the GFC. In those last few years before the GFC, a phenomenon called covenant-light started to make its way into big LBO deals, like the Clear Channel Communication. Like some of these big LBOs that happened in '05, '06, '07 had documents that had very few lender protections. It got up to about 25%. And then when the GFC happened, it went right back to zero. And then it started to grow as we pushed through this bull market in the zero interest rate world. And it's now basically 95% of the market, the loan market, is covenant light. So what does that mean? It means when a company gets in trouble from a liquidity standpoint, from a cash or operating cash flow standpoint, Lenders can't force the sponsor to the table like we used to be able to 20 years ago. That's one. And then two, the technology on the legal side has advanced as much in that everybody knows how to operate within these documents to do things that you would normally never be able to do. And this has led to this whole debate around creditor-on-creditor violence, where one group of creditors that's similarly situated to another group of creditors can do a transaction and move senior to what used to be pari or in the same situation from a waterfall standpoint. And that has created all kinds of optionality for financial sponsors. Let me explain that a little bit more. One of the reasons why the bankruptcy code works so well is because once you're in bankruptcy court, which is a court of equity, you go into it with a contractual right. The company owes you money 6 months from now, let's say. But once you're in bankruptcy, a judge can approve a plan that changes that contract. And the way the bankruptcy works is to get a plan approved, 2/3 of the creditors of each class of creditors need to approve it. 2/3 of the dollar amount, and there's a numerosity test. It has to be 50% of the holders. So the main test is the 2/3 test. What it means is that you can, if 2/3 of you all agree that this plan makes the most sense for everybody, the other third are bound to it. So what it really does is it eliminates holdouts. If we tried to do that out of court, like why wouldn't you, let's say you own $1 million and there's $1 billion debt issuance, why wouldn't you let everybody else extend or equitize and you just hang back and say, you know what, just pay me off in 6 months? So that the bankruptcy process allows you to, it sets up a forum where everybody needs to get to a room and figure out a plan, and then you can cram all the holdouts into it. So you used to have to use bankruptcy to restructure these businesses. With no covenants, though, you can create situations where it's so bad for you to not participate or to hold out that you won't do it. And that's allowed an entire industry to advance over the last handful of years called liability management exchanges or liability management exercises, LMEs. And what LMEs, all LMEs are, is fancy terminology for amend and extends. But you can do them out of court now because you can do things like, let's just say that there's a first lien lender group that has collateral on a business, but there's dividend capacity because there's not a covenant prohibiting dividends. The sponsor could take those assets or a portion of those assets and dividend them out of the entity that the lenders have a lien on into what we call an unrestricted subsidiary. And that unrestricted subsidiary is no longer part of the collateral package. So you thought you were first lien on XYZ business, and all of a sudden XYZ's most valuable asset has been dividended out into an entity that you don't have a lien on. Then what do? You offer people in the lender group the ability to exchange their debt into the new unrestricted subsidiary if you do X, Y, and Z, provide new money or extend your maturity. So what it leaves the holdouts is the holdouts say, okay, I can stay here, but now I'm moving into a second lien position, and they're not deleveraging. There's no equitization. This is just an amend and extend. So the same over-leveraged capital structure, and I'm now behind everybody else. So what you do is you make it so bad for people to hold out that everybody does the deal. That's a deal where everybody's treated pro rata. Now you can start doing deals where one lender group that owns 51% can put up some new money and swap ahead of the other 49%. There's all kinds of stuff that you can do. And at the end of the day, the key takeaway for LMEs is it's provided a tremendous amount of optionality for financial sponsors. They might have an over-leveraged business that's not, where the balance sheet is not refinanceable in today's interest rate environment. They may have a business that's not generating positive cash flow because their balance sheet was floating rate, and with SOFR or LIBOR where it is today, they're cash flow negative on a levered basis. Yet, if you're the sponsor, you're looking at the public equity markets, and you're saying, wait a minute, I understand I'm 8 times levered, and I can only refinance 4 turns today, and I'm not making any money with this 8 turns of, when I say turn, 8 times EBITDA, with this 8 turns of leverage, but the public markets are saying my business is worth 16 times, so I have equity. It's a very weird dynamic. With the sponsor saying, I'm in the money, but you actually look at the income statement and the balance sheet, and you're saying you're insolvent, right? So everything is set up to kick the can down the road because the economy is still good. The company's probably showing the board projections that show revenue growth and margin expansion. So the sponsor's saying, I just need more time. The sponsor's probably also thinking, and I don't want to write my equity down because I'm valuing it based on where public comps trade, and I still have this huge value in my books. And if I go into bankruptcy right now, it's going to be a 0. So the new form of distress today is not bankruptcy investing, it's LMEs. And that's a dangerous new world because without covenants, like you got to know who you're in the deal with and make sure that you're on the right side of the deal. You want to be in the in group and not the out group. And it just, every cycle is very different in terms of the way you make money and the legal technology that's used, but this is a very unique environment where LMEs are probably 70 or 80% of what we focus on. And I bet if you asked most distressed or restructuring focused law firms, lawyers, they would tell you it's most of what they're working on right now as well. Now, if there's a downturn, when these LMEs hit the wall, the quid pro quo in the LME is you give the sponsor or the debtor, the borrower, you give them an extension of maturity, and maybe you give them new liquidity or a coupon holiday if they need it. But what do you get? You get covenants, okay? So this loan started with no covenants. You give the sponsor a 2-year extension, that's probably the average, and you put covenants in the document. And those covenants will make it, if done, will make it impossible to do a second LME. So you get one LME, and the sponsor will either grow and or cut their way into the balance sheet and refinance you. Instead of 25, maybe it will be 27, or they'll hand you the keys then. So I think the bankruptcy investing will pivot from LMEs to loan to own or debt for equity, let's say, when the LMEs hit the wall, or if there's a recession, or both. Because I think if there's a recession, the earnings trajectory will go from growing or flat to declining, and that will put such a strain on these balance sheets, even without covenants, that a lot of them will go in. But right now, most of the companies in bankruptcy are lower quality business. In 2024, we actually only did 2 debt for equity conversion. Most of what we've been doing is LMEs.
How do you think this deleveraging plays out?
So the thing about LMEs is they're not deleveraging. There's very little equity. Sometimes the exchange will be done at 90 cents on the dollar. So you'll take $1 billion of debt and exchange it into the unrestricted subsidiary for $900 million. So it'll be like a little bit of deleveraging, but a real deleveraging happens through an equitization. The only other way that you deleverage is you grow EBITDA. So if you grow EBITDA and the quantum of debt stays the same, your leverage multiples will come down. I think that is going to be hard in a slowing growth world. There's cost cutting that's happening. A lot of these businesses, the sponsors didn't really drive margins higher because you didn't need to. For so long, earnings were good, growth was good, multiples were expanding. You really didn't need to do a lot of this sort of roll up your sleeves. Margin expansion is, there's consolidating factories, there's that kind of stuff, but a lot of times it's headcount. It's reducing headcount, and that's not fun. So for many years, you really didn't need to do that. So a lot of the sponsors are focused on margin expansion now. And if you can get your EBITDA to a level, which is probably 4 times, there's not a lot of refinancings that we've seen that are north of that. You could refinance. You could put equity in, but many of these sponsors aren't going to do that. One is probably throwing good money after bad if you're behind 8 turns of debt. But also oftentimes it's in legacy funds. So it's hard to take capital from your fund 6 and put it into an investment in fund 5. So I don't think there's going to be a lot of equity injections. You could use free cash flow to pay debt down, but none of these businesses have free cash flow. They're too levered, and it's floating rate debt. So the only other way is equitizations, but people want to preserve that option. It's economically sensible for them to do that. So if you can give them 2 more years of time, they'll do that. And by the way, a lot of the lenders don't want to take equity now too. And I put us in that camp, maybe for a different reason. Half of the loan market is owned by CLOs. CLOs don't want equity. It messes up their waterfall. So they're happy to push out and extend. And we have a different motivation. Sometimes we want equity, so we did do 2 debt for equity plays this year, but I'm just bearish on the economy. I think there's going to be better companies in bankruptcy where we'll convert debt to equity when the recession happens or when these LMEs hit the wall. So we're staying in the senior part of the structure, participating in these LMEs for different reasons. Not that we don't want the equity. Our best winners ever is when we converted debt to equity. It's just, I think it's too early. But with LIBOR and SOFR where it is, most of these loans are trading at 80 cents, 85 cents, with a 2 or 3 year maturity, and they're SOFR plus 500 or SOFR plus 600. These are 15 to 20% opportunities. So that to me is distressed returns. Like oftentimes people ask me how I define distressed. Distressed isn't buying debt that converts to equity. It can be, but I define distress as when can you make equity-like returns in credit. The industry standard is 1,000 over, so let's just say 14% right now. I think about it, I think that's a little bit rigid. I think about it more on a risk-adjusted basis. But when you can make equity-like returns, whatever that means, in credit, that's distressed. So if I could do that as a senior lender, participate in an LME, solidify where I sit in the capital structure by putting covenants in the document, and make 15 or 20%, lending to a good business that just has too much debt for the current interest rate environment, that's distressed for me, and that's sleep at night distressed.
Do you want to set Reddit straight on AMC?
I don't even know where to start with AMC because we've done so many different transactions in the AMC capital structure. I can walk you through one we did earlier, which is the latest iteration. But the reason why all these transactions were possible was because the management team at AMC are survivors, and they refused to throw in the towel and file AMC. AMC had an over-leveraged balance sheet. I would have said at the time, although they might make it, but I would have said at the time that it was like a hopelessly over-leveraged balance sheet. They had about $5 billion of debt in the balance sheet. Some of this was incurred during COVID, so it didn't start there, but when we only got involved in it. And before COVID, they had done 800 of cash flow in 1 year, but we had modeled it as a $500 million EBITDA business in sort of a normalized box office environment. Obviously, where theaters were open, theaters weren't open when COVID happened. So 10 times leverage, like that's dead. And most management teams, you know what they do? They file the company and they negotiate with lenders for a new management incentive plan. Usually it's 8 to 12% of the fully diluted company. That's market. And to the size of the company, that's often market. And it's now of a deleveraged business with real equity. Whereas usually the management incentive plan behind all that debt, yeah, you might own 10%, but you're behind $5 billion of debt. It's probably worthless. AMC could have, and 99 out of 100 management teams would have, filed the company, waited for COVID to come out, and come out unlevered or with half as much debt. And then there'd be real equity value, the potential for real equity value, and they could get a big slice of it. Adam Aron did not do that. One of the first meetings I had with him, he said, "This is probably my last gig. I haven't been involved in a bankruptcy before. It's not starting now." He goes, "It may have to. I may not have a choice, but I'm going to do everything I possibly can to avoid a bankruptcy." And if you look at the various trades that we did with, or investments that we made in the company, they were all based on that thesis. They were all based on this company wants to survive. They want to preserve equity value for their shareholders. It may be diluted long term, but anything is better than a zero, and that's what they would have gotten at the time. We did a series of trades that only could have happened because we had a management team that was very motivated to keep the company out of bankruptcy. And again, there were so many of them, there's not time to go through them, but the most recent one we did was an unsub transaction. We talked about LMEs. When AMC had issued all that stock when they were a meme stock, they had effectively like what we call a builder basket for dividends. So there was restrictions on dividends, but if they raised equity, the dividend capacity would go up by the amount of equity they raised. When that provision was put in, nobody thought this company would be able to sell billions of equity. So they had this massive amount of dividend capacity. So the transaction that was announced last summer, which we were part of just this past summer, they basically dividend their most valuable movie theaters into an unrestricted subsidiary that they called MovieCo, MUVICO. That was a newly created entity that was not part of the lender package. We had bought up, us and two other firms, bought up 2/3 of the second lien debt. And our average cost was probably around 40 or 50 cents on the dollar. And we, as part of this deal, exchanged that second lien debt. So there's $3.5 billion or something like that of first lien debt ahead of us. We exchanged our second lien debt into 25 cents of first lien debt at MovieCo, which was now leapfrogging the first lien lenders on the best assets of the company, as we dividended all the best theaters into MovieCo. And the other 75 cents we put as a 1.5 lien, so junior to the first lien, but ahead of second lien, that was convertible. Why is that important? This is still, even today, even that we're past, at least right now, past the sort of meme craze, this is still a very volatile stock. So like the implied volatility on near-dated options for AMC right now is like 120 or 130. Whereas normal vol might be 30 or 40. So it's still a very volatile stock. And if you think about what a convert is, it's a debt instrument stapled to an option on the equity. And one of the biggest determinants of option value is volatility. So we thought that this convert would be very valuable. And after the deal was announced, the convert was trading at 125 and the first lien on MovieCo was trading at a par. So this debt that we had bought for 40 and 50 cents on the dollar, we exchanged into this new entity. It didn't exist prior to this transaction that had the best assets of the business. And we had a package of securities north of par. So a lot of what we've been doing with AMC is almost what I would call capital structure arbitrage. Like here's a company that it has a core business, but it has too much debt. But you have a management team that will do almost anything they can to keep the company out of bankruptcy. And as fiduciaries to the shareholders, I think that's the right thing to do. But what they're doing over time is converting debt to equity one way or the other. They're either selling equity to pay debt down or buy debt back and retire it. They're converting debt into debt that's convertible into equity, sometimes at a haircut. And they don't really care what happens between first lien and second lien and 1.5 lien. They don't care if we're senior to Apollo or Apollo senior to us. That's let us fight it out. All they care about is to keep the company out of bankruptcy. And we'll see what happens. I don't think that the final chapter is played out yet. They still have an uphill battle. Look, they might make it, and we're certainly rooting for them. We have zero AMC exposure today, but we've done lots of different trades in the structure. But for the Reddit listeners, if that's who we're addressing here, they were all meant what was driving our interest was clearly profits. We were trying to make money, but they were all structured to facilitate keeping the company out of bankruptcy, which allowed it to become a meme stock and allowed lots of people, whether you made money or lost money, to trade in the stock. We never owned a stock. We were always playing in the debt side of the capital structure, all transactions that only would have happened because you had a management team that wanted to do everything they possibly could to keep the company out of bankruptcy.
Jason Mudrick, thank you for joining us and sharing your excellent insights.
Thanks, Joe. Good to be here.
Thanks for listening. If you enjoyed the podcast, please leave us a review on Apple Podcasts or share it with your friends. Thank you.